Hi, this is James Ng with Old Capital, and I'm here with Drew from Mag Capital Partners. Drew, how's it going?
Hey James, good to see you.
So, Drew, you're joining us here in Dallas. So appreciate you jumping on. I guess maybe to kick it off, give people your background and then more about your company.
Sure. Oh man, I don't know how far back you want to go, but I was an entrepreneur very early in life, and found myself buying and selling a few houses and doing well there, and realizing that I didn't want to be a active real estate manager, flipper, Burr method guy, and really started to get exposed to the private investment world, the passive investment world, and over time got introduced to a few different sponsor groups and started to invest with them closely and get closer to them personally, and eventually found myself jumping in this world with both feet. And so, really, as of today, it's been 5 years since I joined Mag Capital Partners, but our firm's been in existence since 2015. And so, previous to that, I'd been participating in some deals with them as well. So, it's been a fun ride, and really continue to invest my own personal portfolio as well as run the capital market side here at Mag Capital Partners.
You said you were an entrepreneur in your before you joined Mag Capital. Any businesses or any industries that you can talk about?
Sure. Yeah. I mean, it was one business. When I was 20, I actually had the opportunity to buy a business that I was essentially running with a friend, managing for a serial entrepreneur. The owner had, I think, about 8 different businesses that he
Okay.
owned and managed. And we essentially managed this food and beverage distribution company, mostly snacks and bottled beverages for the most part, sold to cafes, delis, etc. And so he said, I want to get rid of this thing. And we had the opportunity to buy it. We scraped together as much money as we could, borrowed money from our parents. I was 20, and actually took some years away from school. I said, this is a better opportunity to learn than anything I can get from a classroom. So jumped in with both feet, and later on, sort of saw how things were going. I said, well, I need either $10 million of investment to make the next leap up,
Right.
or I need to, get back and finish my degree in finance, which I did. So yeah, it was a great experience. And still to this day, I attest I learned way more running that business than I ever did in school.
Right, right. All right. So transitioning back to sort of Mag, I know you've been with the firm about 5 years, but sort of talk about what you guys have invested in, sort of structure of how you guys do it, and get into that because I think it's a little bit more unique than most sort of syndicators out there.
Sure. Yeah. We really have a focus on single tenant industrial real estate. As of today, we manage a little over 1 billion in assets, and the vast majority of that is exactly that kind of asset. Typically, industrial property that has a long-term absolute triple net lease in place that's backed by a privately held manufacturing company. I mean, that is about down the middle as we get, and our deal flow and what we're doing is pretty rhythmic. And within that box there, we're opportunistic. We've done some other deals outside of that particular set of criteria, but this is where we see the most deal flow because we have a lot of reputation in this space. And to get more specific, most of these transactions are sale leaseback transactions where we're buying a property from an owner user, simultaneously executing a 15 to 20 year triple net lease with them. They stay in place. It's a very kind of seamless transaction, and it's really a financing transaction for the seller. For us, we have day one stabilized real estate that cash flows really well, so you could see the appeal.
Okay, so that was a lot of info, I think, for guys who are thinking, this is a value add multifamily deal. So, uh, tell us tell us about how in industrial and did you ever invest in apartment syndications or were you always on the industrial side when you first started investing?
I actually stayed away a little bit from multifamily. I was really looking for more stabilized cash flow.
Triple net stuff. Okay.
Yeah,
All
yeah,
right.
really
So
some.
I'll try to throw in some apartment terms and maybe you just fix it or change it with industrial terms. So a lot of people will buy apartments and let's say the rent is $1,200 and they're going to spend $1 million in rehab, and they're going to take it from 1,200 to 1,400. And then in 3 to 5 years, they're going to sell it, and they might make, let's say, 5% cash on cash on average the first couple years. But then when they sell it, they get, I don't know, 70, 80% return total.
Sure.
So the IRR might be, let's say, 15% on average over 5 years. So compare that to like your industrial deal, because I think that's what most people are used to some extent. So explain sort of how you're like, if you're an LP in your deal and you put in 100,000, what does the cash flow look at? Like, what does the sort of capital gain look like on a typical deal? And you can
Yeah, I
just pick
love
one
it.
deal if you want. If you just want to pick
No,
like
no,
one deal
I
that you
love the
bought. Yeah.
comparison. I mean, we've had single asset deals that we've syndicated. We manage several funds with
Okay.
single tenant industrial real estate that, and they all behave pretty similarly, right? Again, most of those transactions are very rhythmic, very similar in nature. And so I love the comparison, right? Because I see and I have invested in some multifamily deals like that in my own personal portfolio, and you see that 15 to, we'll call it 15 to 20% projected IRRs. A lot of times that, mid to high teens, we'll call it.
Right.
And we're kind of right about there, right? 15, 16% IRRs that we're typically projecting. And so, but it behaves much different during the life cycle of the investment where, hey, multifamily value add, hey, we're going to have very little to no distributions because we're going to allocate capital towards improvements,
The
right?
rehab. Yeah. Rehab of the
Yeah, we have
units.
a
Yep.
business plan to execute. It's capital intensive, and we're going to be, there's going to be some vacancies while I'm turning units. All of that it's not conducive for cash flow to an investor early on, at least,
Right.
right? And we're going to see a bigger pop of profits on the back end when we sell this and reap the rewards of all the work that we've done. Now, what we're doing is a little bit different, where we have an equity investment but stabilized from day one. It's going to cash flow in the high single digits from day one. And so usually looking at 7 to 8% from day one, cash on cash to investors. And that's there's a very high degree of certainty there, which we'll get into. But you have this higher cash flow from day one and a more gradual value add over time as we're paying down debt. We're not using, full interest only bridge loans, for instance, or, any kind of product like that. We're amortized debt. We're seeing very predictable and gradual increases in NOI because there's no expenses there and the leases have annual rent bumps. You see NOI going up 2.5%, 3% every year. And so over time, you'll see that happen. And, we find some opportunities to add additional value when we can, whether it's expansion developments for the tenant or any other number of ways we can negotiate for a lease extension or what have you. But even all that aside, you see this more gradual value increase and cash on cash still going up over time, right? Rent bumps and using fixed rate debt, we see that free cash flow go up over time. So a more modest pop of profit on the back end, but a much higher and healthier cash flow with a higher degree of certainty during the hold. So that's kind of how I would, wrap up the behavior of those two different types of investments, and they carry different elements of risk.
Yeah. So talk about because usually the lease on a multifamily deal is 1 year and there's 200 tenants, right? So if one guy leaves, you just put somebody else in there and
Right.
essentially go on your way. And there's really not that much. Everybody wants bathroom, bedroom.
Yeah.
So it's pretty basic on what you have to change. You might have to spend 5,000 a unit or something when it turns. But let's say you buy a deal and you do the sell lease back that you're talking about. And now, okay, they sign a 20-year lease. And then do you plan on holding it the entire 20 years? Or after 5 years, are you just gonna sell it? Like, what's the typical hold period on some of these triple net deals that you guys are
Yeah,
doing?
we're typically targeting 5, 6 years, right? We want to enjoy
Okay.
the cash flow, reap as much depreciation benefit as we can,
Okay.
typically using up a lot of that in the first 5, 6 years anyway.
Okay.
And really what we're selling after 5, 6 years, instead of refinancing out, we're typically looking at a sale. There's a lot of value there in an asset that has, 10 to 15 years, we'll call it, of lease term remaining for buyers looking for predictable yield, right? So, hey, I'm looking for triple net lease assets. I want cash flow. I want something that's really stabilized, and that's what we're exiting at that time. So very nice to be able to execute that very long-term lease versus a 10-year lease where you hold it for 5 years. When you sell it, there's a lot of lease renewal risk for a buyer, and it's not going to trade that well, frankly, if you're getting closer to lease expiration. But 10 plus years is a very attractive asset for a buyer. So that's really our exit strategy and full life cycle of the investment.
Can you talk about, you don't have to give the name of the company, but give me an example of something that you guys have closed maybe in the last, I don't know, year, where you bought it sort of rough cap rate, you did the sell lease back, and then what size are we looking like? Are we looking at 5 million, 10 million, $20 million deals? And then what did that company sort of do with that money? Because now before, let's say they owned it free and clear, now they've got to pay you guys, right? Like
Sure.
their monthly rent, right? So talk about sort of how that all is figured out, because I'm guessing it's a negotiation between you and the seller, of trying to figure out, like, okay, you're going to pay me 20 million, but then what's my rent? Like, I think
Sure.
that's a little different than what we've seen on apartment deals, obviously.
Yeah, capital doesn't usually come for free. And
Yeah.
it's what a seller is going to look at is, look, we're looking for a financing instrument to do X, Y, or Z, right? It might be to buy more efficient equipment for manufacturing. It might be to free up some cash to acquire a competitor, roll them up.
Mm, okay.
Could be a number. Sometimes they're just using this to retire short-term debt that's more expensive.
Mm,
And they say, look, at a cap rate of, you know, 8.5%, let's say, this is still a lower cost of capital than the short-term debt. And I can reduce that debt on my balance sheet. Rent for them on their balance sheet is a footnote, according to
right.
modern day GAAP accounting rules. So they see that, and they have tax deductible rent payments. It's you can see there's a lot of advantages there for a CFO as they're sort of looking at different financing transactions and how they would affect their balance sheet. But yeah, a recent transaction we bought just outside of Chicago, about an hour outside. We did a sale leaseback with a new 20-year lease. The tenant manufactured the actual machinery for metal fabrication, bending. Basically, they're selling to other manufacturers, right?
Okay.
So it's manufacturer to manufacturer sales, M2M, we'll call it. So at the end of the day, this company said, "Hey, we'd like." Well, sorry, I should back up to the motivation of the sale leaseback. The company was acquired by a private equity group,
Okay.
and private equity group comes in, and the seller of the company says, "Look, we're selling the business and the real estate." And so the private equity group goes, okay, great. We'll take this. They negotiate a deal for the whole thing, but they don't want to tie up capital in real estate.
Right.
Your private equity group, your mission statement is to buy businesses and not tie up your capital there. And frankly, they see a higher return on investment from injecting capital into these investments and growing the actual operating company. So in this case, you actually really didn't see an additional rent obligation. The previous owner had a propco entity, and they had their operating company paying rent to the
Okay.
propco.
Yeah,
Right?
yeah.
So from a income statement and balance sheet side, you are still looking at very similar rent obligations. And now instead of this ownership of the previous ownership of the company holding that real estate separately, it was all bought by private equity group, and then they spun off the real estate to us, and now we own the real estate piece of that. So a lot of these transactions can follow M&A activity, where private equity groups, again, looking for a real estate partner. And in that case, is very seamless, and it's really just a who wants to tie up capital in real estate, and we and our investor group do, right? We see below basis industrial real estate, highly sought after, with a long-term lease that gives us a lot of certainty, backed by this very successful manufacturing company. And so we're happy to take that kind of yield. Again, private equity group says, no, we're not interested in real estate.
So a lot of times, on multifamily, we'll look at, okay, let's say 10-year treasury is 4%. And then the cap rate that we're buying a deal at, we want it to be, let's say 150 basis points higher, like 550, to compensate for the risk of taking on a multifamily deal. And then for you guys, what type of premium are you typically looking for on top of, let's say, 10-year treasury? Is that, does that make
Let's run it
sense?
on debt, right?
It's on the debt. Okay.
We're getting fixed rate debt, and I
Okay.
mean, I don't know what you're seeing out there. I'm on the capital market side talking to lenders every day, and if they're pricing off 5-year treasuries, which is pretty common in the debt
Yeah.
world, they'll say, "Look, it's 5-year treasury rate plus 275 basis points." So
Okay.
um, today we're looking in the mid sixes or so.
Sixes.
So if
Okay.
you're looking at 6.5%, we're typically looking for 150 to 250 basis points of spread between
On
that
top.
fixed rate of interest on the capital we're borrowing and
Mhm.
our cap rate. So that spread is really where the yield comes from, and that's what we're targeting. We're saying, look, where is the yield? We need to see that. Sometimes you might find, in our funds, for instance, every asset's going to be a little different. Some will be a little fatter yield, some will be a little thinner, and that's going to be usually commensurate with the risk with each asset, right? But it's pretty surprising, and you know this in your line of work too, right? Sometimes you go, hey, we paid a little bit more, a little lower cap rate for this asset, but it's close to New York City, and you might actually find that the financing is extremely attractive there, right? You have a
Right.
lot of lenders saying, hey, we're going to compete really hard because we like assets in this primary market. We saw that recently with a deal where I assumed we were just going to end up with a somewhat thinner yield on
Spread.
this
Yeah.
particular deal. And again, that's natural. You're going to have some fatter, some thinner. And the debt we lined up was extremely aggressive,
Mm.
where a lender we had worked with before said, we absolutely love this asset. We love this market. And here's our pricing. And by the way, you can tell we want this deal, right?
Right.
So
Yeah.
lenders, when they really want something, you have a lot of advantage on your side. And so at the end of the day, we still had about a 200 basis point spread there that we were looking for.
So in my previous life, I was an underwriter for GE Capital, and we underwrote across like office, industrial, retail, multi, everything. And we didn't win many multifamily deals. We did a lot more office and industrial deals. And my job was to get the lease of 50 tenants and figure out where the holes were in those
Right.
deals. So you have one lease. And so tell me, number one, what happens? I mean, you guys have been doing this for a while. So at some point, one of these tenants has left the building or just stopped operating or got bought out or something happened. So tell me what happened on one of those deals, maybe. And then number two, sort of what do you look for in those leases to make sure that if something does happen, you still get paid for the remaining term?
Yeah, great question. And we obsess on this aspect of risk, right? And this is where the risk is in this investment strategy, single tenant default risk.
Right.
Because we've eliminated all those operational risks, right? Hey, we don't have to worry about day in and day out, multifamily vacancy, execution of the business.
CapEx of the, yeah,
Right, right. What are my washers and dryers and lumber is going to cost? Are those commodities pricing changing? All of that is something we've kind of eliminated. Even property tax, property insurance, which has gone through the roof recently. So all that we're insulated from, it falls on the tenant. But yeah, we have this concentrated tenant risk. So I'll start with the leases, and then I'll give you an example
yeah,
of a lease default. So the leases, we require quarterly financial reporting, I'll mention, as well as the annual rent bump. So we're really monitoring them and looking at their financials, and we're looking for trends, right? So we're looking to see if there's, hey, 3, 4 quarters in a row of declining revenue or EBITDA margin. What's happening? Let's have a conversation with them, and we know if we need to take action earlier. But also, really, as far as how we're protected well is really the type of real estate you're buying, right? At the end of the day, you're going, who's this organization and what are we holding? We want a mission critical operation site. And so that's what we're looking at. If you have a company that has 10 locations and they say, hey, we're going to do a sale lease back of this building, and you find out that it's sort of this is where they take receipts of raw materials for the manufacturing operation down the street, right? If these guys go through chat, reorganize, that's absolutely going to be an asset that's on the table to get axed,
mm,
right? They can go through bankruptcy court and say, look, we're going to reject this lease. We'll move out of there. We're downsizing to save the company and continue to live and fight another day, right? That's typical and very common as far as bankruptcy goes. Not shutting down your doors, it's just a reorganization. So we're looking for that headquarters. We're looking for that key manufacturing site down the street that, frankly, if they were to shut down, they don't have a company,
Right.
right? The headquarters. This is where, the whole sales and C-suite is housed. This is where they do R&D and the manufacturing. A lot of these companies are one single site, so that's always a nice one too. Look, we're holding the most important assets, on their books here, or even if we own it, this they can't survive or function as a company without it. So we're in a really good position there. But yeah, going to lease defaults and stories there. I mean, I wish I had a whole bunch of war stories. It's good that we don't because
Right.
our credit team, I mean, kudos to our credit team. They do a fantastic job really looking at, again, how critical the nature of the site is, looking at the financials, interviewing the C-suite of these companies, and looking like a private equity group does, right? What's the landscape of this industry? Where's it going? Who are the competitors here? So really want to understand them. And that's the other side of the coin of having a single tenant, right? You go, hey, if they default, what happens? Well, I don't know any kind of background on Johnny at apartment 101. He may move across the country to be with his family. That's okay, right? I got 100
Right.
other units. In this case, we have a really deep understanding of the tenant, the credit, what direction they're going. And again, they're signing a long-term lease for a reason. But yeah, I mean, really out of over 100 single tenants properties that we've had leases on here, we've had one default. And really that was a black swan situation. Company manufactured aerospace components, a helicopter crash. They blamed the crash on this component manufacturer,
Mm.
said, hey, it's a faulty part. So you can imagine huge amount of liability, a lot of lawsuits flying around. Bell Helicopter was the manufacturer of the helicopter that went down. They had a huge amount of accounts payable. They just cut it off. So yeah, the company ultimately filed bankruptcy. And during that process, we actually never missed a dollar of rent. The bankruptcy judge goes, hey, you still have equipment in this property. So we were in a very strong position there. Even though they were shutting down their operation, they continued to pay rent, right? Because they have cash there and the bankruptcy judge is going to direct traffic. Who gets paid? Who doesn't? Right.
Right.
And so they say, as long as you have equipment there. So at the end of it, we marketed the property for sale and we had a really defensible basis on the real estate. And that's a strong piece here is I have real estate at a good basis. That's okay. We can survive and even make a profit here without the tenant, with them completely going out. And in this case, we sold the property for a nice profit actually, and returned capital and profits to investors and said, hey, we just sold this thing. We stepped out of it. We're not going to re-tenant it. It would be a long process. We could, but here's a nice clean exit with profit. No one was complaining. So really that's the only time we've had a tenant default on their lease. And that's how it worked out. So good example of here's what you're buying, not a corporate bond, a piece of real estate, a hard asset.
Right. And then, so most of your deals right now, in a fund structure where like someone invests 100,000 and now it's in like, it's got 20 properties or 30 properties or however many properties. Are they more syndications? I know you said you did both, but do you have like a percentage breakout roughly of fund versus individual syndications?
Yeah, I mean, 90% of our transactions are guided towards the fund. For
Okay.
years
Yeah.
now, we're on our third industrial fund now. So, all that industrial real estate deal flow,
Yeah.
it's rolling right up into the fund, and we're creating a diversified portfolio and spreading out that risk, right? That single tenant
Yeah, I
risk.
think that I think that makes sense. It's almost like your own little triple net multifamily deal. If you've got
Uh,
20 properties and then even if one did, have an issue, maybe that drops your occupancy to 95%, right? Versus it
yeah,
dropping from 100 to zero, right? On one deal.
yeah.
Yeah,
Yeah, and
yeah,
that example I just gave you with the tenant default, I mean, we probably in that situation, if that particular deal was in one of our fund, which it wasn't, but if it was, we probably would have said, look, we're going to work through a release process. And we probably would have seen some very nice upside on it, by the way,
right.
because we were below market rents. There were 8 buildings on the property. We could have cut that up if we wanted to. It would have taken some time, but we would have had a portfolio of, 20, 30 properties to continue to support debt service and continue to support that property while we work through it and seeing a little more upside on the back end. So yeah, that stabilization, that diversification across the fund, I mean, almost makes more sense for what we do than any other asset class because we don't have that diversification of tenant profile in a single asset there. So yeah, we're pretty focused on the fund, but any opportunities we see outside of that, recently we did a single tenant office headquarters building. It's not industrial real estate, so we syndicated it separately. If we saw a single tenant retail sale leaseback opportunity, we've seen some of those. We would do that outside, but our primary focus is industrial, and anything that's not industrial, we won't go into the industrial fund that we manage.
Well, I appreciate you coming on. I know you'll be at the conference here in October. But if someone wanted to get in contact with you beforehand, what's the best way for people to reach out if they have any questions about the fund or your company, anything like that?
Sure, they can go to our website, www.magcp.com, or they can email me directly if they just want to shoot me a question. That's Drew, DREW, at magcp.com. And
All
reach
right.
out. We're happy to chat.
All right. Appreciate it. Thank you, Drew.
Thanks, James.
All right.